Good morning, everyone. Let me ask you a simple question. Do you want to know which assets are about to create a wave of new millionaires over the next 3 years? I'm not talking about luck or get-rich-quick schemes. I'm talking about real, tangible opportunities that are quietly building wealth for smart investors right now. Today, I'm going to reveal the 6 assets that are positioning people to get rich. If you act strategically, you could be one of them. In today's financial landscape, opportunities move fast. While most people are chasing trends, the truly wealthy focus on assets that compound value over time. Over the next few minutes, I'll break down 6 powerful assets that are set to explode in value and show you exactly why they're game changers for building wealth in the next 3 years. By the end of this talk, you'll know not just what these assets are, but how to position yourself to benefit from them. Technology stocks with high growth potential are some of the most exciting opportunities for investors today, because they represent industries that are not just growing, but transforming the world. Companies at the forefront of artificial intelligence, robotics, cloud computing, and advanced software solutions are not only innovating, they are creating entirely new markets and redefining old ones. When you invest in these companies, you're essentially placing a bet on the future, on the way people work, communicate, and conduct business in the coming decade. These are businesses with products and services that people and corporations increasingly rely on, which gives them a powerful edge over traditional companies with slower growth trajectories. Take artificial intelligence, for example. AI is no longer a concept limited to labs or science fiction. It's integrated into software, automation systems, healthcare, finance, and even entertainment. Companies developing AI algorithms or platforms that businesses adopt for efficiency are experiencing revenue growth at unprecedented rates. Investors who recognize which firms are building scalable, adaptable AI solutions can see exponential returns as demand for these services skyrockets. It's not just about the technology itself, it's about the ecosystem around it, including data infrastructure, AI chips, and enterprise integration, all of which contribute to the growth potential of these stocks. Similarly, cloud computing has fundamentally shifted how businesses operate. Companies that provide cloud storage, software as a service, or platform solutions have recurring revenue models, which make their earnings more predictable and sustainable. This stability combined with growth potential makes technology stocks in the cloud sector highly attractive. Every business, from small startups to multinational corporations, is moving operations to the cloud, and companies enabling this transition are positioned to dominate the market for years to come. Investors who understand this trend can identify stocks that are undervalued today but likely to capture significant market share in the next 3 years. Robotics and automation are also transforming industries from manufacturing to logistics to healthcare. As labor costs rise and efficiency becomes more critical, businesses are adopting robots and automation tools to stay competitive. Companies developing cutting-edge robotics, industrial automation, or advanced machinery are not only solving real-world problems but also creating high barriers to entry for competitors. Investing in these businesses offers exposure to industries with strong growth drivers and long-term potential. Finally, technology stocks offer scalability that other sectors often cannot match. Unlike traditional businesses, technology companies can serve millions of customers globally without proportional increases in costs, which means profits can grow exponentially. The combination of innovation, global reach, recurring revenue, and increasing adoption makes high-growth technology stocks some of the most powerful wealth-building assets available today. Those who study trends, understand the underlying technologies, and invest with a long-term perspective can position themselves to benefit significantly as these companies expand and shape the future economy. Cryptocurrencies and blockchain assets represent one of the most transformative shifts in finance and technology in recent decades, offering opportunities that traditional investments simply cannot match. Unlike stocks or bonds, cryptocurrencies operate on decentralized networks, meaning they are not controlled by any single government or institution. This decentralization provides both security and transparency, as transactions are verified and recorded on a public ledger, making manipulation extremely difficult. For investors, this opens the door to assets that are not only innovative but also capable of operating independently of traditional economic cycles, offering a unique layer of diversification in a portfolio. The growth potential in the cryptocurrency space comes from several angles. First, there are the established digital currencies like Bitcoin and Ethereum, which have demonstrated remarkable resilience and adoption over the past decade. Bitcoin, often referred to as digital gold, has become a store of value for both retail and institutional investors, while Ethereum enables complex smart contracts and decentralized applications that are changing how businesses operate. These assets benefit from network effects. The more users, developers, and businesses that adopt them, the more valuable and entrenched they become. Investors who recognize the long-term implications of these networks can position themselves to benefit from both price appreciation and technological expansion. Beyond the major cryptocurrencies, the next wave of growth lies in emerging coins and blockchain projects that solve specific problems or serve niche markets. These could include decentralized finance platforms, tokenized assets, or blockchain-based supply chain solutions. Each of these projects introduces new use cases, increasing the demand and utility of their tokens. Investors who carefully research and identify projects with strong fundamentals, real-world adoption, and capable development teams can gain exposure to significant upside before these assets become mainstream. The challenge lies in separating hype from genuine innovation, which requires diligence, education, and an understanding of the underlying technology. Another compelling factor is the role of institutional adoption in driving growth. Over the past few years, major financial institutions, hedge funds, and corporations have begun to allocate portions of their portfolios to cryptocurrencies and blockchain-based assets. This influx of capital provides legitimacy and stability to the market, while also increasing liquidity, making it easier for investors to enter and exit positions. Coupled with regulatory developments that provide clearer frameworks, institutional involvement helps cryptocurrencies move from speculative experiments to viable components of a diversified investment strategy. Blockchain technology itself also presents opportunities beyond individual tokens. Companies leveraging blockchain for smart contracts, identity verification, or secure data management are creating new revenue streams and business models that were previously impossible. Investors who can identify these opportunities early gain exposure to assets that could grow exponentially as blockchain adoption accelerates across industries. Ultimately, cryptocurrencies and blockchain assets combine innovation, scarcity, decentralization, and real-world utility in a way few traditional investments can. They offer a chance to participate in the creation of entirely new financial ecosystems, where growth is driven not only by speculation but by adoption, technological advancement, and market demand. For investors willing to educate themselves, take calculated risks, and stay ahead of emerging trends, these assets have the potential to deliver transformative wealth in the next 3 years and beyond. Real estate in emerging markets is rapidly becoming one of the most powerful ways to build wealth, especially over the next few years, because it combines tangible value with long-term growth potential. Unlike mature real estate markets, which often have limited upside due to already high prices and slower economic expansion, emerging markets are experiencing rapid urbanization, population growth, and rising incomes. These factors create strong demand for both residential and commercial properties, making strategic investments highly profitable. When investors enter these markets early, they can acquire assets at a fraction of the cost compared to developed markets, positioning themselves for significant appreciation as demand continues to increase. The key advantage of emerging market real estate lies in the combination of scarcity and economic momentum. Cities that are attracting new industries, foreign investment, and skilled workers are seeing exponential growth in housing and commercial space requirements. As infrastructure improves and international businesses establish a presence, property values rise, often much faster than in established markets. Investors who can identify which cities or regions are on the cusp of transformation have the opportunity to benefit from both rental income and capital appreciation simultaneously. Rental yields in these areas tend to be higher as well, providing steady cash flow while the underlying property increases in value. Another compelling factor is the diversification real estate provides. Unlike stocks or cryptocurrencies, real estate is a physical asset that tends to hold intrinsic value even in times of economic uncertainty. In emerging markets, this resilience is often amplified by demand from both local populations and foreign investors seeking stable returns. For investors willing to navigate the complexities of international property investment, these assets offer exposure to economies with higher growth rates than developed countries, reducing reliance on a single economic cycle. Technology and innovation are also shaping emerging market real estate. Digital platforms for property management, online marketplaces, and data-driven investment tools are making it easier than ever to identify, evaluate, and manage properties remotely. Investors no longer need to rely solely on local connections or in-person visits. They can access real-time market data, track rental trends, and even conduct virtual tours. This increased transparency reduces risk and allows more precise decision-making, making it feasible for sophisticated investors to capitalize on opportunities that were previously difficult to access. Additionally, government policies in many emerging markets are increasingly supportive of foreign investment, offering incentives, streamlined registration processes, and legal protections for property owners. These developments make it easier for investors to enter markets that were once considered risky or opaque. When combined with favorable currency movements, these factors can amplify returns even further, creating a potent wealth-building strategy for those who act strategically. Investing in emerging market real estate requires research patience and a willingness to understand local economic trends, but the rewards can be substantial. By focusing on regions with growing populations, expanding infrastructure, and increasing business activity, investors can position themselves to benefit from both short-term rental income and long-term appreciation. For those looking to build tangible wealth over the next 3 years, strategically chosen properties in emerging markets offer one of the most reliable paths to financial growth, combining safety, opportunity, and the potential for significant returns that outperform more saturated, slower-moving markets. Dividend-paying stocks are a cornerstone of wealth building because they provide a unique combination of income and growth, offering investors both stability and the potential for long-term returns. Unlike growth stocks that rely solely on price appreciation, dividend stocks generate regular cash flow, allowing investors to reinvest those payments or use them as a source of income. This dual benefit makes them particularly appealing for both conservative investors and those seeking to compound wealth over time. Companies that consistently pay dividends tend to be financially stable, with predictable earnings and strong balance sheets, which reduces risk compared to more speculative investments. The power of dividend-paying stocks lies in compounding. When dividends are reinvested, they purchase additional shares, which then generate more dividends in the future, creating a snowball effect. Over time, this compounding can turn relatively modest investments into substantial sums. For example, even a small allocation to high-quality dividend stocks can grow significantly over a 3-year horizon, especially if the market conditions favor consistent earnings growth and companies continue to increase their payouts. Investors who focus on dividend growth stocks, rather than just high-yield stocks, can benefit from both rising income streams and capital appreciation, creating a more balanced and resilient portfolio. Another important aspect is the defensive nature of dividend stocks. During periods of market volatility, companies that pay reliable dividends tend to experience less severe price swings because investors value the steady income they provide. This stability can be particularly advantageous in uncertain economic climates, offering a buffer against downturns while still participating in potential market gains. Dividend-paying stocks often belong to established sectors such as utilities, consumer goods, healthcare, and financial services, industries that provide essential products and services regardless of economic cycles. This combination of income, stability, and growth potential makes dividend stocks an essential component of a diversified investment strategy. Furthermore, dividend-paying companies frequently demonstrate strong corporate governance and disciplined financial management. To sustain regular payouts, these companies must maintain healthy cash flows, manage debt effectively, and focus on long-term profitability. For investors, this provides an additional layer of security, as these firms are less likely to engage in risky ventures that could compromise shareholder value. Companies with a history of increasing dividends year after year also signal confidence in their growth prospects, which can attract additional investment and further support stock price appreciation. Tax advantages can also enhance the appeal of dividend-paying stocks, depending on jurisdiction. Many investors benefit from preferential tax treatment on dividends compared to other forms of income, which can increase net returns and further enhance the compounding effect. Combining dividend income with a disciplined reinvestment strategy can create a self-sustaining growth engine within a portfolio, providing both immediate cash flow and long-term wealth accumulation. Overall, dividend-paying stocks are a powerful tool for investors seeking consistent returns, risk mitigation, and compounding growth. By focusing on companies with a history of stable or rising dividends, investors can generate a reliable income stream while benefiting from potential capital gains. Over the next 3 years, these assets remain a key opportunity for wealth creation, providing a balance of safety, predictability, and growth potential that few other investments can match. Commodities with scarcity trends offer investors a unique opportunity to protect and grow wealth, because they combine intrinsic value with strong demand dynamics that are difficult to replicate. Unlike stocks or bonds, commodities represent tangible resources: gold, silver, rare earth metals, oil, and agricultural products that have real-world uses and cannot be easily created or duplicated. This inherent scarcity gives them a natural hedge against inflation and economic uncertainty, making them a critical component of a diversified investment strategy. When supply is limited and demand is rising, prices tend to move upward, creating potential for significant gains over relatively short periods. Precious metals like gold and silver have long been considered safe havens during times of market volatility. Gold, in particular, is recognized worldwide as a store of value, and its price often rises when traditional financial markets experience turbulence. Silver, while also serving as a hedge, has the added advantage of industrial demand in electronics, solar panels, and medical devices, which creates multiple layers of value. Investors who allocate a portion of their portfolio to these metals can gain protection against currency devaluation, inflationary pressures, and geopolitical risk, while maintaining the opportunity for capital appreciation as scarcity and demand intensify. Beyond traditional metals, rare earth elements are becoming increasingly valuable due to their critical role in modern technology. These elements are essential for producing high-performance batteries, smartphones, electric vehicles, and advanced defense systems. Global demand for rare earths is growing exponentially, while supply is concentrated in a few regions, creating scarcity and price pressure. Investors who understand the industrial applications and geopolitical considerations of these materials can identify opportunities for significant returns as technological adoption accelerates. The combination of rising demand and constrained supply creates a favorable environment for long-term growth in this segment of commodities. Energy commodities like oil and natural gas also remain essential to the global economy, and supply disruptions or geopolitical tensions can create rapid price movements. While energy markets are more cyclical than precious metals, they offer opportunities for strategic investors who can anticipate demand patterns, production changes, and broader economic trends. Similarly, agricultural commodities such as wheat, corn, and soybeans are influenced by climate, population growth, and global consumption trends, providing additional avenues for investment diversification and growth potential. Investing in commodities requires an understanding of market dynamics, storage, and delivery mechanisms, but the advantages are clear. They offer a hedge against traditional financial market risks, provide exposure to global economic trends, and allow investors to benefit from scarcity-driven price increases. For those looking to protect and grow wealth over the next 3 years, commodities with rising demand and limited supply offer a compelling opportunity to combine stability with growth potential. The strategic value of these assets goes beyond immediate financial gain. They serve as a foundation for portfolio diversification, reduce exposure to inflation, and provide access to sectors of the global economy that are essential and irreplaceable. Investors who carefully analyze supply constraints, technological applications, and economic trends can position themselves to benefit from the scarcity-driven rise in commodity values, creating a strong path toward building wealth in the coming years. Alternative investments, such as startups, private equity, and specialized funds, offer investors access to opportunities that are often unavailable through traditional markets, providing the potential for exponential returns. Unlike publicly traded stocks or bonds, these assets operate in less regulated, less crowded environments where early entry can result in significant upside. Investing in startups, for example, allows individuals to support companies at the ground level, often before the market fully recognizes their potential. These investments carry higher risk, but when successful, they can deliver returns far beyond what conventional assets typically offer, making them an essential consideration for those looking to accelerate wealth creation over the next 3 years. Private equity is another form of alternative investment that allows investors to participate in the growth of established companies that are not listed on public exchanges. These companies may be undervalued, undergoing restructuring, or expanding into new markets. By providing capital and strategic guidance, investors can help these businesses unlock value, benefiting from both operational improvements and market appreciation. Private equity investments often require longer time horizons, but the payoff can be substantial, particularly for individuals who have the patience and knowledge to evaluate opportunities carefully. Specialized funds, including venture capital funds, hedge funds, and real asset funds, provide access to diversified portfolios of alternative assets. These funds allow investors to leverage the expertise of professional managers who identify high potential opportunities, manage risk, and navigate complex markets. For individuals who may not have the time or expertise to research individual startups or private companies, these funds offer a structured way to participate in alternative investments while spreading risk across multiple assets. The combination of professional management and exposure to high-growth sectors makes these funds an attractive component of a forward-looking investment strategy. Alternative investments also benefit from lower correlation with traditional financial markets, which adds a layer of diversification to a portfolio. While stocks and bonds are influenced heavily by economic cycles, interest rates, and market sentiment, alternative assets often move independently, driven by unique factors such as technological innovation, industry consolidation, or niche market demand. This independence reduces overall portfolio volatility and increases the potential for steady growth even in turbulent economic periods. Investors who incorporate alternative assets alongside traditional investments can achieve a balance between risk and reward that may not be possible with conventional strategies alone. Another critical advantage is the opportunity for active involvement and influence. In startups and private companies, investors often gain advisory or board roles, providing insight into strategic decisions and operational improvements. This level of engagement not only increases the likelihood of success, but also allows investors to directly shape the growth trajectory of their investments. In addition, early access to high-potential companies can create networking opportunities and open doors to additional ventures, compounding wealth beyond the initial investment. Ultimately, alternative investments represent a powerful way to position oneself for outsized returns by targeting assets with limited access, high growth potential, and strategic influence. They require diligence, research, and sometimes higher risk tolerance, but the rewards can be transformative. For investors seeking to build significant wealth in the next 3 years, carefully selected alternative investments provide the chance to participate in groundbreaking companies, emerging industries, and specialized funds that are driving the next wave of financial opportunity. As we wrap up, remember that building wealth isn't about luck. It's about identifying opportunities before they become obvious and taking strategic action. Technology, cryptocurrencies, emerging market real estate, dividend stocks, scarce commodities, and alternative investments each offer unique pathways to financial growth. The key is understanding their potential, managing risk, and positioning yourself now to benefit from the trends shaping the next 3 years. Wealth favors those who act with knowledge and discipline, not hesitation. Start today, stay informed, and let your investments work for you. Because the next wave of financial success is waiting for those ready to seize it.